Hello everyone, and now I'm back with another video. This video is about the total payout and free cash flow valuation model. And this model is about what happens when a company, instead of just paying out dividends, is buying back shares. And all the assumptions, or what we are basing this assignment on, or this exercise, is that the market is completely efficient, which means that every information is available, and in general, when companies are buying back shares, there is a big signaling effect in a real market situation. Therefore, this is only more theoretically than compared to the real world, where there is some effects. Because in a real world, if a company thinks that the company is worth more, then they would have an interest in buying back shares. Therefore, companies in a real world situation would have to make themselves as transparent as possible by having a payout policy, and make these policies changes, or these actions, this change of actions, they should be made in the far out in the future. But yeah, let's get back to this assignment. First up, we want to find the same thing as before in the exercise. What was that? That was E9. Yeah, E9 or I9, sorry. And it's basically asking us for the same. What is the share price of the furniture houses of furniture house? What is the share price of furniture house? And there's some assumptions. Payout rate and expected growth rate remain constant, which is important, because then we can use the constant, what is that called? It is called the constant dividend growth model, which is as follows. Dividend 1 and the return of the equity cost of capital, which is the RE, and the growth is 4%. Let me write all that down. Info. Dividend. The dividend was 3.31, and the growth was 4%, and lastly the equity cost of capital is 12.3%. And obviously this is the two examples I have been going through here. In the first and the second one has been the constant dividend growth model, but there is also like other models, such as dividend discount model, where the dividend can change the 1 year after another year. And then there is the multi-year investor, which is maybe just interested in looking forward some amount of years. And then there is the 1 year investor who just looks ahead in 1 year. But from this perspective, we are more interested in like the price of the firm, and are focusing on the constant growth, dividend growth model. Okay, back to it. So we know from before that when we plot these numbers in, we find the price of furniture houses stock price. Okay, and we do this by just taking this one minus, and then we get the price of the stock, and we with 3 digits. Okay, so we already know that, but that is always nice to be reminded of how that was. Okay, next question. Suppose furniture house decides to pay a dividend of 0.89 this year and use the remaining 2.42 per share to repurchase shares. If furniture houses total payout rate remain constant, estimate furniture houses price. Okay, here we have to look at the total payout model. The total payout model says that the present value of future total dividends and repurchases divided by shares outstanding times 0, which is when all of this happens. Then we can find the PO. So because we don't have the shares outstanding, we can just find the present value of the dividends and the repurchases, which would be the same as using this formula. Now and what we will see in a minute is actually that the share price will not change, because obviously also because they are not changing anything. They are just like buying, they're just paying out dividends and buying back shares, but the investors who are willing to sell, they can just, the shares can then just be bought back to the company, and they will, instead of having the dividends, they will just earn the cash. And in any case, investors don't care if they get it out in cash. The shareholders don't care if they get the money or the cash out in through repurchasing or dividends. They are more interested in the earnings and the cash in general. Yeah, and then we'll do this in Excel just to make sure that we are not skipping any steps. So PO and this is also a smart idea to just click on the different cells instead of writing them in yourself, because then you can mess up. And also, if you are making templates for the exams, then you will have a quicker way of changing stuff. Maybe if they say a type question where you can just use the same formula for that, and then you can just like change what is yellow and then get the rest of the answers. Yeah, and you should then also like put these in cells, these two, the dividend and the remaining 2.42 that would be repurchased. Okay, and yeah, I'll do this. And as we can see, I'll just do the same formatting. We get the same result. So the same result as before. Yeah. And now so yeah, what happened here is that the shareholders really don't care how they get the money. However, in a world where there's taxes, there might be some preferences, because the company might be able to make the money, like get more value out of the money, because corporate taxes are less than private taxes. When you're having dividends payouts, you might you will have to pay a higher tax than the firm has to pay. But so the overall idea is that in this situation where there is no taxes, this is a complete market. There is like no taxes, or it's an efficient market where everything changes from one moment to another when a new announcement is out. Yeah. Okay. Next question is that okay? Furniture house maintains the same split between dividends and repurchases, and the same payout rate as in part B. As what rate are furniture houses dividends, earnings per share, and the share price expected to grow in the future? Okay. We now have all this information from before. The dividend will be the same as in the question B, at a 0.89. What would we then expect the growth to be? Then we can just like change the formula. We have the formula right here, and if we are changing that and isolating for G, yeah, I don't want to bore you too much with that, so I'm thinking that I'll just find it and plug it in, but you can, it's basic algebra. So you get that the RE, the equity, cost of capital, minus the dividend, will get you the growth rate, the expected growth rate. So yeah, we can just plug it, because nothing has changed actually. So we can just plug in the numbers and the price of the asset and minus, oh no, plus the capital, the equity cost of capital, and then we find plug that in Excel. Boom. 0.89 divided by, oops, 89 divided by the stock price, and we would expect to have a growth rate of 10.068%. Yeah, that was it. I hope you find it useful, and I hope you would like to subscribe and like my channel, so I can continue helping you. This is it's the best way of making me motivated to continue. If people are finding my content interesting, if you want me to go more in depth with the different assignments, I can also do that. But please write in the comments and like the videos if you find it useful. Yeah, I hope to see you again. Bye.